Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about OI Glass Inc. Annual Report. OI Glass Inc. offers a diverse range of businesses and services through its subsidiaries. The company's primary focus is on manufacturing and selling glass containers to various industries worldwide. Specifically, it produces glass packaging for food and beverage manufacturers, including alcoholic beverages such as beer, spirits, and wine. In addition to these products, OI Glass also provides glass containers for other items like soft drinks, teas, juices, and pharmaceuticals. The company offers a wide range of sizes, shapes, and colors to cater to different customer needs. Its sales strategy involves direct distribution to customers through annual or multi-year supply agreements, as well as partnerships with distributors. Overall, OI Glass Inc.'s services encompass the production and sale of glass containers for various industries, including food, beverages, pharmaceuticals, and more. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause OI Glass Inc.'s stock price to increase. The stock price of OI Glass Inc. has increased in the past year due to several factors that have contributed to its growth and success. One major reason is the company's efforts to improve operational efficiency and reduce costs. By streamlining its manufacturing processes and implementing cost-saving measures, OI Glass has been able to maintain a competitive edge in the market. Another factor contributing to the increase in stock price is the growing demand for glass packaging products. As consumers become increasingly environmentally conscious, they are opting for sustainable packaging solutions, which has led to an uptick in demand for glass containers and bottles. OI Glass has been well positioned to capitalize on this trend, with its diverse portfolio of brands and products. Additionally, the company's strategic investments in digital transformation and innovation have also paid off. By leveraging technology to enhance its manufacturing processes and improve customer experience, OI Glass has been able to stay ahead of the competition and drive growth. Furthermore, the company's commitment to sustainability and social responsibility has resonated with investors and customers alike. OI Glass has made significant strides in reducing its environmental footprint, which has not only improved its reputation, but also attracted socially responsible investors who prioritize ESG, environmental, social, and governance factors. Overall, the combination of operational efficiency improvements, growing demand for glass packaging products, strategic investments in digital transformation, and commitment to sustainability have all contributed to OI Glass Inc.'s increased stock price over the past year. OI Glass Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $4 billion. OI Glass Inc. trades at a lower price-to-book ratio of 1.57 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 84% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted sales and profitability over time. Revenue growth is primarily driven by higher selling prices, which have exceeded cost inflation, resulting in increased operating profits. This trend has been observed in the Americas segment, where net sales have increased due to higher selling prices. Additionally, non-U.S. net sales have also seen a 2% increase compared to the previous year. On the other hand, revenue decline is primarily attributed to lower sales volumes and average selling prices. The Europe segment has experienced a significant decline in net sales due to lower average selling prices and reduced glass container shipments. Furthermore, declining shipments to alcoholic beverage customers in North America have also contributed to the revenue decline. Other factors that have impacted revenue growth or decline include seasonality of customer demand, changes in consumer preferences or customer inventory management practices, consolidation among competitors and customers, and fluctuations in foreign currency exchange rates. Additionally, higher non-cash charges and lower working capital levels have also contributed to a revenue decline. The net income of the company experienced a significant fluctuation between 2024 and 2025. In 2025, the net income decreased by $23 million from 2024, but increased by 9.7% compared to the same period in 2024. This increase was largely due to a decrease in charges related to liabilities. However, when looking at the overall trend, it is clear that the company's net income has been decreasing over the past 2 years. The profit margins of the company also underwent changes between 2024 and 2025. The segment operating profit increased by $98 million, while earnings before income taxes decreased by $87 million. The gross profit margin improved by 1.2%, but the overall profit margins, gross profit/net sales, decreased by 3.4%. The reasons for these changes are multifaceted and complex. The company cited impairment charges, declining shipments to customers in North America, and an update to management's long-range plan as contributing factors to the decrease in net income. Additionally, the company mentioned valuation allowances against deferred tax assets, potential global tax legislation changes, and corporate tax reform as reasons for the decline in profit margins. Overall, the company's financial performance has been impacted by various external and internal factors, leading to fluctuations in net income and profit margins. The company's ability to generate positive operating cash flow is inconsistent. On one hand, the financial reports show that the company generated $600 million in cash provided by operating activities in 2025, indicating a positive operating cash flow. This is an increase of $111 million from the previous year, suggesting improvement. However, other sections of the report reveal a different picture. The net earnings for 2025 were minus $378 million, which implies a negative operating cash flow. Furthermore, pages 57 and 102 also indicate that there have been years with negative operating cash flows. This inconsistency raises questions about the company's financial stability and ability to sustain positive cash flow over time. The company's debt level has experienced significant fluctuations over the years. Initially, long-term debt increased by $596 million between 2023 and 2024, reaching $1.25 billion. However, this trend was short-lived, as the debt level decreased by $66 million in 2025. A more substantial increase of $284 million was observed in 2026, bringing the long-term debt to $4,837 million. In terms of interest expenses, there has been a modest increase from $335 million in 2024 to $341 million in 2025, representing an uptick of $6 million. This growth is attributed to various factors, including finance fees and premiums that rose by $5 million in 2025. Furthermore, the company's annual net interest expense would change by $15 million with a 1 percentage point shift in interest rates. The most notable changes occurred due to debt refinancing and termination of cross-currency swaps, which significantly impacted interest expenses. Additionally, the accumulated benefit obligation for defined benefit pension plans increased from $2,227 million in 2024 to $3,246 million in 2025. The performance of various segments and regions has been mixed, with some showing significant losses while others have excelled. In the North American region, a substantial impairment charge of $445 million was recorded in 2023, indicating poor performance. Similarly, the retained corporate costs and other segment incurred a loss of $1 million. On the other hand, Europe stood out as a strong performer, successfully hedging foreign currency exchange risk through derivative financial instruments. This strategic move helped mitigate potential losses, contributing to its overall success. The Americas segment, Europe segment, Canada, China, Latin America, and Asia-Pacific region did not have specific information provided regarding their performance. The management of the company is outlining a clear vision for its future growth and sustainability. The new vision, "Together, we put the power of glass within reach of everyone, every day," emphasizes collaboration and accessibility. To achieve this goal, the company has established a value creation roadmap with 3 horizons: fit to win, profitable growth, and strategic optionality. The ultimate objective is to increase shareholder value by reducing costs and driving profitable growth. The company plans to explore energy efficiency initiatives, invest in sustainable manufacturing technology, and focus on product innovation and automation. Additionally, the goal of using 40% renewable electricity and reducing total energy consumption by 9% by 2030 demonstrates a commitment to sustainability. Management also highlights the importance of employee development and talent pipeline through strategic investments. However, they acknowledge potential risks and challenges, including financial constraints, foreign currency, exchange rate fluctuations, and uncertainty in the market due to changes in tariff and trade policies. Overall, management is emphasizing the company's focus on growth, innovation, and sustainability, while acknowledging potential risks and challenges that may impact its future performance. The company's acquisitions and divestitures have been significant over the past few years. On the acquisition side, the company has made efforts to expand its business by acquiring new companies and expanding existing plants. For example, it acquired businesses on page 53 and expanded plants on the same page. The costs associated with these acquisitions are recorded at estimated fair values at the date of acquisition. On the divestiture side, the company has been actively shedding non-core assets to focus on its core business. This includes the sale of divested businesses and miscellaneous assets, which resulted in a gain of $-5 million in 2024. The company also made deliberate decisions to exit unprofitable businesses as part of its network optimization efforts. Additionally, it closed several plants and furnaces in the Americas and eliminated selling, general and administrative positions in the same region. The divestitures continued into 2025, with a gain on sale of $5 million. The company has also initiated a strategic review of its remaining businesses in the former Asia-Pacific region. Overall, these acquisitions and divestitures demonstrate the company's efforts to streamline its operations and focus on profitable business segments. The company's capital management strategy is evident through its recent actions. One notable aspect is the implementation of a $100 million anti-dilutive share repurchase program. This move indicates that the company has chosen to buy back shares, thereby reducing the number of outstanding shares in circulation. In contrast, the company has suspended dividend payments since 2020. Despite this decision, it remains clear that the company's primary focus lies in managing its capital structure and maintaining a strong financial position. Concerns about inventory buildup and supply chain disruption are evident in various aspects of the company's operations. One key issue is the accumulation of finished goods inventory, which increased by $36 million, 4.9%, from 2024 to 2025. This suggests that the company has been holding onto more stock than necessary, potentially due to temporary curtailments of production volumes aimed at balancing supply and demand. Furthermore, there are indications of potential supply chain disruptions. The downturns in business or financial condition of suppliers could result in a loss of revenues or disruption in raw material supplies. Additionally, global supply chain disruptions may continue to impact the company's ability to procure materials and equipment. This is supported by the decrease in glass container shipments by approximately 3% in 2025. The potential for future supply chain disruptions also exists due to plans for permanent closure of several plants and furnaces to align business with demand trends. These closures could lead to a loss of production capacity, further exacerbating supply chain issues. Overall, these concerns highlight the need for the company to address inventory buildup and mitigate potential supply chain disruptions to ensure future financial stability. That concludes the financial summary for O-I Glass Inc. Feel free to comment below, and I will be happy to answer them when possible.